please have your attention? So we move on to our panel discussions. Our morning sessions today focus on our portfolio companies, where we delve deeper into different aspects of their growth journey and what steers them to keep building and striving to achieve their dreams relentlessly. Our first session discusses the new set of challenges faced by our startups as they gear up to become coveted domestic and global icons. The topic therefore deliberates on the biggest dilemma faced by our startups today: growth versus profitability, focusing on the consumer tech companies. The panel will be moderated by Mr. Ashish Wadhwani, Managing Partner, IvyCap Ventures. Ladies and gentlemen, please welcome our panelists on stage. Mr. Vishal Jindal, founder of Biryani By Kilo. Mr. Gaurav Singh, founder of Bluestone. Mr. B.G. Krishan, founder of eShakti. Ms. Neha Kant, founder of Clovia. Mr. Rahul Dash, founder of Purplle. And Mr. Sneh Vaswani, founder of Miko. Welcome, everyone. Before we begin our session, please feel free to post our event feeds on social media using our hashtag IvyCapDay 2022. And our virtual audiences can post their questions by clicking on the chat box. Ashish, stage is all yours.
Thank you, Mansi. And welcome everyone to the portfolio sessions. It's a pleasure to be back in person. And obviously, those of you who have been here before, lots of familiar faces. In fact, now so familiar that they are probably inside your houses in various ways. Very well-known brands. And some new faces. I can see Sneh is here for the first time. Of course, BBK has been with us for a while. So let me get started very quickly. I think, gentlemen and ladies, why don't you take a quick 60 seconds to explain your business and what you are trying to do? Let's start with Neha.
Hi, I'm Neha. I'm founder of brand Clovia, which is a lingerie brand. Now also doing sleepwear, basically all things intimate. Like you said, brands that have gotten into homes, I think we are a brand that has gone much further. I would say close to heart. We've so far been able to reach 4 million women, and in next 3 years, we intend to find the right size and fit for 50 million women.
Thanks. Hello, everyone. Very good morning. My name is Sneh Vaswani. I represent Miko as the co-founder and CEO. Miko is a global deep tech consumer electronic brand that makes Miko robots that engage, educate, and entertain kids. We've been able to build AI that leads to a transformative development of any child that engages with the product. And today, it's an Indian brand gone global, just following up from the discussion in the previous panel. So today, almost 90% of our revenues are coming from outside of India with users across 140 plus countries. We are crossing 100 million revenue mark next year with a PAT of 5%, with an EBITDA of 5%. And the aspiration is to get to $1 billion revenue 5 years from there. Thank you.
Amazing.
Hello. Sorry for the glitch. Our technology works better. I'm Rahul. We are a digital-first beauty company, and a couple of brands in our stable that you know. One is a retail omni-channel brand, which is Purplle.com, which some of you guys would know, I hope. And then we also have a brand now in the beauty product space, Faces Canada, which a lot of ladies here should be aware of. So we basically have an online platform and an offline platform. On online platform, we do cater to about 8 million women on a monthly basis. And on the offline platform, we are distributed in close to about 7,000 to 10,000 outlets near you. Some of you guys might have seen us there. That's what we do. Thank you.
Hi, I'm Gaurav Singh, founder and CEO of Bluestone, India's leading online jewelry company. So we started in 2012 as a D2C online-only brand. Over time, we have realized that omni-channel is the way to go. So while the first phase of growth with online was pretty strong, and by 2016, uh, uh, we had actually already served almost 100,000 customers. One of the things that we were noticing in the market was people, while online was great for browsing, because of the nature of the products, because of high value products, people wanted the touch and feel of the stores also. So we started the rollout of our omni-channel stores somewhere around between 2017 to 18, and right now we have 100 plus stores across 40 plus cities in the country.
Hello, am I audible? Yeah. My name is B.G. Krishan. I founded a company called eShakti.com, which got into customized clothing about 13 years ago. First of all, I want to thank IvyCap for having me here. We are arguably the #1 company in the world in customized clothing for women. And customized clothing for women in terms of customized to their size, to their style, and even fabric. And this is very important because it's not a niche market, it is a mass market, because most clothing companies are limited by the kind of inventory they can carry to be able to serve the great variety of heights and sizes and shapes and style preferences that women have, and that leaves many women underserved. And we have, therefore, a global market. Almost 100% of our revenues comes from the US and Europe, and we are now looking at India as well. Thank you.
Hi, I'm Vishal Jindal, founder of Biryani By Kilo. We are the only company to make fresh handi biryani on every individual order. And not only biryani, it's kebabs, kormas, and a wide range of Indian desserts. We are opening our 100th outlet next week in Calcutta. And very proud to say it's all women's outlet. So keeping in the And like Gaurav said, we also believe in omni-channel. So there's one dine-in outlet per city. So we have around 30 dine-in outlet also, which also serve as a cloud kitchen. So we are in more than 40 cities now in India. So north, south, east, west, tier 1, tier 2. I think this October to December 2022 quarter run rate should be 300 crore plus. So we are the biggest biryani and kebab chain in this country. And our ambition and a clear vision is to take Indian biryani, which is our heritage, and I think a much more healthier and a more aromatic, flavorsome dish, if I can say, than any burger, pizzas, not only to India in the most authentic, delicious way, but to the rest of the world as well, to create the biggest F&B chain from India. Thank you.
So thank you very much. And you know, it's very difficult not to observe that many of these brands, if not all, are going to be dominant players for decades, or hopefully a decade or decades to come. So, you know, when I think of these founders, you know, I'm actually reminded of Formula One. All these guys had a new car. They were on a treacherous sort of turf or track. They had a lot of people racing with them with their own fancy cars. They have limited fuel in terms of funding. And they have been told to go at breakneck speed without crashing and win the race, right? And that ties in very well with the growth versus profitability idea, right? So I want a very quick sort of response from you, all of you, as how did you think of it? Did you think of it as, let me go fastest with whatever fuel I have, get to the next stop, get another round of funding, and then take it from there? Or was it more punctuated in terms of balancing growth and profitability?
Let me start now. So of course, as founders, we are quite ambitious, driven, most of us here. And we want to go at the fastest speed. But we all know that clearly you can't finish on fuel. That's the end of the journey, right? So in terms of cash or, profitability, I'm comparing. So like we, in Biryani By Kilo, if I take our specific example, we have grown 80-90% CAGR since 2015, except one COVID year. That's how you become a 300 crore company in 4, 5, 6 years. And probably we are targeting 1,000 crore plus revenue in another 2.5 years at most. So of course the growth is at a breakneck speed. But of course you take punctuations off and on depending on the funding environment overall. But I think it's a bit more nuanced also in every business. Let's say in our business, we need to put commissaries, let's say, in, let's say, Bangalore, Calcutta, different places, or let's say Handi factory, or invest in marketing, or a corporate structure which can support few hundred crores. So you have to always keep balancing it. But I think, I'll take an example. We take we take an overall number. I think the overall numbers have to be kept in mind. Let's say if I'm going in America from New York to California, right? If let's say it's a few thousand kilometers journey, but I think overall the average speed matters. So I think in terms of the broad numbers, how we look at it is, let's say we have spent a tad over 150 crores plus a tad over that in the last 6-7 years, and we will be running a ARR in October to December, the next quarter, 300 crore plus. So how we look at it is ARR divided by capital spend should be at least 2. So that's our, and as long as we are growing more than 60-70% CAGR, so between capital efficiency and growth, and of course at some point, and that's a founder has to make, and the investors or the board has to make that call, that whether the profitability has to come in 2 years or 5 years, depending on the whole overall vision. But of course, the fuel can never finish while you are, no matter what speed you are going.
Gaurav, you want to add to that?
Sure. So in our case, and so around, so there was a time around 2015-16 when there was a lot of VC money chasing very high growth startups, similar to what we saw in last couple of years. I think that was the time when we had, then we were seeing a lot of funding happening purely on growth numbers, and the profitability had taken the back seat. So that was, so I would say that around for around 6-8 months, we had actually gone on that path, but there was a quick realization that what it was leading to was a distortion of value proposition that we had actually created for the consumers, and also that it was not going to be sustainable. So I think we'd kind of come back from there, and since then we've been very, very particular about the kind of growth that we are getting. Ideally, I would want to grow 2x, 3x, 4x, whatever I can, but the growth has to be right. It should not be distorted growth. And what had happened was, once you had realized that, then the profitability kind of came naturally, because our category has very high ASPs and very high margins also, to the tune of around 35 to 40% gross margins at an ASP of 30 to 40,000, right? So profitability at a fundamental level was always there. What had led to loss making around 4-5 years back was that obsessive focus on growth, which we'd been able to kind of curb, and then grew profitability and almost at break even since then. And we've been growing. So last year we doubled while still being profitable.
So you make a great point around artificial growth actually distorts your value proposition, right? Rahul, I know you have been a great proponent of that. Can you elaborate on how you saw it in your category?
Yeah, am I audible now? Wonderful. Okay, so I actually agree with Vishal. That's one way we had looked at our things. Organically, we have done organic and inorganic. So we have bought some companies. In some cases, we have grown organically. When you look at organic growth, we've typically had a 1:3 ratio in terms of revenue that we got to with respect to the capital that we consumed organically. So that's one metric that we look at. and inorganic obviously will play out because you make an upfront investment. So that's one part of the story. We've been very, very, and Ashish knows this from a long time. We've been very, very clear on pushing back on growth that we don't consider is growth. So if you're paying someone 1 rupee, the person gives you 1 rupee worth of GMV in our case. So for example, that's not growth. We don't believe that's growth. So we have taken months and quarters in between our journey every time to just break. And this is akin to the F1 example. For you to grow really fast, you need to break really well. So that's something that we do consistently over the years. We have done it for multiple months. So that's one thing that has worked, at least when we look at our P&L and our growth. And the second thing that has worked is differentiating between what is an investment and what is an expense. And we get super confused. We have seen people getting super confused between ये expense है या investment है, and trying to justify it with LTV CAC calculation, which are in the future or on an Excel sheet. Businesses don't run on an Excel sheet. Thankfully, we were young. We learned it slightly early in our career. Otherwise, we would have been dead, is what I think. But those are the two things that we have done in our business.
You make a great point around getting confused between expense and investment. But you know, some of you alluded to capital efficiency, right? And again, if we go back to the theme, creating dragons, one of the key components of that is capital efficiency. Because from an investor point of view, it's about how much can this team and this business model stretch that $1 invested and make it go all the way, right? And I think I know for certain that all of you have done a wonderful job on it. But let me challenge you a bit on that. And you keep coming back and telling us we are the most capital efficient. And Vishal, you are smiling because you've said that to me many times. And can you prove that's true?
So see, I come from a finance background. See, capital efficiency, finally there's one last parameter which defines it, is return on equity, right? I think that's the holy grail of capital efficiency, right? Like as an investor, when I was investing in some public markets, like I never invested in a company which is less than 20% ROE. So I think that's a benchmark. So let's say, let me go back to the numbers I said. Let's say 150 crores tad over that we have spent till now in 6-7 years, and a 300 crore ARR. So SF now, we are not profitable on entity level, but soon we will be, and this will be a 20% entity level EBITDA company. So tomorrow, given the same parameter on 300 crores, if we wanted, we could have been, if we were not growing at 80-90% CAGR, we would be throwing 60 crores of EBITDA on a capital of 150 crores spent. So that's almost a 40% ROA. So finally, the number on capital efficiency, if we don't get confused, is, let's say, in the short term, it's ARR, annual revenue run rate, divided by, sorry, I'm being too technical in the morning, divided by the capital spent. So if it's 2, and we know in our sector, we will at least get 5 times, sales run rate. So it makes our investors money 10 times, right? 2 into 5. Or if I look at a return on equity basis, right? So finally, it has to be, any good business, any, self-respecting business would look at a 25% ROE, right? So we will fare much, much better. And also if I can take, so see, we are 2 times our capital spent in ARR today. But let's say if I look at outlet level, we can put an outlet at 50-60 lakhs, and it gives us individual revenue of close to 3 crores and more once it's mature. So that's 5-6 times. So of course, in the last 5-6 years, they were like capital spend on branding, marketing, expansion, losses. Going forward, this will even improve. So this will be Hindustan Liver kind of companies which don't really need much capital, or the brand companies have ROEs in excess of 40-50% also. So that's what we believe in. This Biryani By Kilo will be also a 40-50% ROE business going forward. So that's how I define capital efficiency.
And is there a consistent thought process across the group?
I think that's
See, I'm not a finance man. So probably shows. Um, See, when you spoke about all these Grand Prix races, when we started out, we didn't have a car. We didn't have a driver except me. And we didn't have a road because we're creating a new category. So at that time, we made a lot of mistakes in terms of how we looked at the financial projections, the capital required, leave aside capital efficiency. And our experience is the more of a disruptive or an innovative or a new category creator you are, the more difficult it is to say beforehand what exactly you need. More so if you're trying to create a market in the US in a competitive space. So that learning process and getting things done, definitely, slightly variable in terms of time.
Sure, yeah, absolutely. And I'll come to that point, just spark that point, because I think one of the things we have to cover is different stages, different weightages, right? But Neha, I think you guys did some benchmarking without getting into numbers with your peers, right? And can you elaborate on what you found and what was the secret sauce?
Yeah, I think Clovia had an interesting journey. You gave an example of, you spoke about F1, and once you are in that lane, then you're right, you have to go fast because to grow slowly also means that you are dying slowly. But I think the key was also to time your pit stops, the key to winning. Through different stages of Clovia, when we kept raising funds, there were times when we grew fast, but we always maintained CM2 or channel EBITDA is what we called it, better known as CM2 with all direct cost, variable cost built in. We always stayed positive on a unit level. So it was like Rahul spoke, on every order, we never made any, we made profit, and therefore, the growth wasn't being bought. So when there were times when the mood of the room changed and, the funding environment changed, we could easily ride that wave out, and we timed up pit stop therefore very, very well, I feel. When we started, it's an apparel business enabled by tech. The way we explained ourselves was that we are bringing right fits to Indian women. Largely like this, the room was full of men. People didn't understand. They thought it's a latent need. We spoke about how using tech, we are able to now iterate our fits while on the production lines and getting closer and closer to accuracy. Again, Vikram and Ashish got it, but not many people got it. But thankfully, somewhere along the line, somebody did us a favor and coined the term D2C. And not just us, quite a few people out there, and then the environment completely changed. So I think there will be cycles, and you just need to time your pit stops well.
Yeah, I think it's very interesting. I keep getting battered with this question as to VCs are dumping money on consumer companies, and they go out and give discounts and buy consumers. And what I can hear is you guys are shattering that myth, right? All of you. And I want to get to the how, and I think I'll want some input from Gaurav, you and Rahul. What is the secret sauce that you have found in sort of making sure you are capital efficient and you can take that dollar and make it go a much longer way?
So I think, in fact, I would again go back to 5-6 years back when there were lots of consumer companies. There were 3 to 4 companies in the furniture space. There were at least 5 to 6 companies in the jewelry space. There were plenty of companies in the lingerie space also. So what had happened, and in fact, many of them were like heavily funded. $100 million, $150 million, $200 million also. So I think what also happens is once you have so much funding and your expectation from growth is also in line with that. So at times you don't have any other option but to actually spend a lot of money to buy those users, and not having enough money or not having raised enough money in that cycle in a way kind of proves to be a blessing in disguise, because that kind of keeps you more efficient at a company level also, and you are less prone to kind of going out or going belly up when the cycle turns. So I've seen a lot of companies which were heavily funded kind of going belly up when the cycle turned. We did not raise as much capital, or we did not raise excessive capital at that time, and hence the expectation of growth, etc., were also were logical, were not excessive. And I think that is what had helped us kind of build it the right way. Otherwise, I mean, from founder's perspective also, it's not easy. Once you have set the wrong expectations, once you have said that, okay, I mean, give me 200 million and I'll grow 5 times in 2 years. And if that kind of growth is not natural in the category, you'll end up doing the wrong things. So I think it kind of it plays from both the sides, from investor side also, because they also at times read it incorrectly, the kind of growth that category can potentially deliver in 2 years, and founders also. So I think a lot of it is chance also.
Again, great point around responsibility of investors to give you the right amount of time and right amount of capital at the right time. Rahul, what's been your secret sauce?
I think clear focus on P&L, which is again going back to the same point, expense versus investment, super important. Very heavy investments on technology side. That's been a big driver of the revenue that we generate per unit fixed cost that we have, and we have different fixed cost on the business. That's an investment that we started doing with our first institutional check with IvyCap in 2015. We have built out a very strong proprietary technology stack specific to beauty. Hopefully at some point in time it will go global. For now it has been built for India, which makes us super efficient when it comes to the browse experience on the platform, when it comes to acquisition of customers outside of the platform, when it comes to developing our own brands and products that we can offer to the consumer, which are differentiated. So all of these things are based on the technology stack, not on people, and that's something that we think has helped us in terms of the amount of capital that we have consumed. And it started showing in the fact that we as a company have been able to return the entire fund of 3 of our early stage institutional investors, all 3 of them. IvyCap, we returned the first fund, if I'm not wrong, if my calculations are correct. JSW Ventures will be returning their fund a little more, and probably our third institutional investor, Bloom, also. So that's what we have done as a company. But the input has been differentiating between expense and investment and heavy technology investment. We are a technology company. We can't shy away from it.
Great. Let's shift to the point, and Sneh, I'm looking at you. A point was made around different stages, different speeds, and different consumption of fuel. How do you look at your equation through the journey?
So basically, for a company like Miko, there's a lot of, in the initial years, there's a lot of product development that you need to do. And we've always ensured that at each, and later on you start growing in a market, and then you start expanding your markets into new markets and so on. So at each stage, what we've set as a North Star goal is based on the resources that you have, you aim, and what a regular company in a similar space, because like BG had said that you're building a new category as you go forward. So in a similar company trying to do with the resources, where would they have got? You try to aim for a much higher goal with your leadership team, so that at each point you are able to make the best out of the resources that you have. And that mindset has been there since day one. Just to put it in perspective, like if you were a US based company, to get your first product out, you would need at least $20 million. And we went from a whiteboard concept to retail in less than $1 million. And then to launch in the US in a big fanfare, one would need at least another $20, $30 million, as most consumer brands in the US do that. And we did it in $6 million. So at each point, based on the resources that you have, we aim for a North Star goal for that year, higher than that, what is possible. And it is achievable. It's not that you'd set 2 long shot goals, which is just not achievable. It is achievable, but you need to think non-linearly in your marketing, in your operations, in your supply chain, in your product, on how you get there. And that's how almost every vertical of ours has a massive non-linear innovation led by technology, led by pure business sense to get to that point with utilizing minimum capital.
And again, a lot of you have been kind of emphasizing getting things right, getting the building blocks right, technology or supply chain, and of course the kind of product and so on and so forth. BG mentioned also early stage experimentation. Do you think that getting that right then gives you much further acceleration further down in the race to go ahead of your competitors?
It gives you tremendous conviction as an entrepreneur that you'll be able to face any other challenge going forward also that comes by.
Absolutely. Anyone else wants to add to that?
See, I think if until there's a product market fit and the product is right, you can't take the car on the kind of speed we all want to take or F1. So I think that is the first thing, no matter how much time it takes, it has to be right. So without that, there's no point in speeding up. The whole thing will blow up, right? So I think that's the first step, no matter what. Something which can be scaled then very fast. So I think a lot of time, energy, investments have to go into it. And like Rahul was saying, so I think I'll also like to put it in maybe the same points, maybe in a different way. Like everyone should, I think in the company, like say in our case, our outlet level EBITDAs are quite healthy. Like the older outlets, 25, 30% or even more. Or, in case of Clovia, the CM2, or the similar companies like Mama, the CM2, those numbers have to be 25, 30% plus for any company to sustain. So that is, I think, so that we know the unit economics is right. And then every company has a fixed cost of tech, corporate. If you really want to create a world-class company of at least 1,000 crore plus, or I think there's a fixed expense which a founder or the team has to understand of tech, corporate, marketing, the supply chains. Let's say in our case it's 100 crores. Let's say we want to create a world class. So we have to, and I know our CM2 or outlet level EBITDA is 25, 30%. So after 400 crores, we know it's a very profitable journey because then everything gets thrown back, that 25%, every incremental dollar. So in every case, see that unit economics will only come that CM2 or outlet level if the product is right. And then you have to really, once you've done that right, I think you have to move on to know that if you take a number of 500 crore or 1,000 crore or 5,000 crore, what is the kind of that fixed tech marketing corporate base to get the best people and tech in place you need? Because the unit economics will always support you. But once, let's say you have so I'm repeating myself now, but once you know your unit economics and you know your fixed cost, which is required in tech corporate, then you press the accelerator once you've done both the things.
Great. I think the messaging here is pretty clear as to how you need to drive the car and take care of it.
So I have a point of view on that, Ashish. So essentially, I think in businesses where in order to execute that business, you actually have to build a lot of things, or you have to do a lot of things. For example, in our case, we do our own design, we do our own manufacturing, the entire tech stack, all the way from website to factory management to point of sale, everything is in-house, right? So in business like this, where a lot needs to be done before taking to the market, and the market is not like running away tomorrow, it makes sense to get your product first and then scale, and that gives you tremendous ability to actually then scale it much, much faster and much, much more efficiently. At the same time, sometimes there are games or sometimes there are markets where the product depth is not that much. At the same time, the market is wide open, right? So if you don't do it, someone else will do it. For example, cars, right? Uber, Ola, that game we've all seen. I mean, eventually it's just one app or two apps. There's hardly anything you can go do beyond that. Let's say it would take you 3 months, 4 months, 5 months to build. But if you just try to get that perfect, while waiting to scale, someone else will walk away with the market. So you cannot. So in those kind of games, you have to actually scale and just build it along the way. So it entirely depends on the kind of game you are in.
You can't be very slow either. I mean, like Neha said, if you're very slow, you basically die. Neha, you wanted to say something.
Yeah, I was just adding to what Vishal said. We spoke a lot about P&L, EBITDA, CM2, but I think sometimes it also helps to take a traditional approach to your business and think about focus more on cash flow rather than anything else, because there are times, and if I may say so, in a room full of VCs, that is not the funding you need. You have other sources of money. Equity is the most expensive money that you will pick, but there are other methods to get to fund certain items like Gaurav just spoke, your inventory, your investment in stores, your infra. I think it's important to keep an eye on your cash flow, more important possibly than anything else.
Great. Let's shift direction a bit now. we are pretty clear that over the last 6 to 8 months, not only was the track already treacherous, but it's rained. It's become even more difficult track because fundraising is harder, right? And multiples are crashing and so on and so forth. Tell me, how do you see the new world? As in, if this paradigm were to stay for the next few years, what are investor expectations from companies like yours, as well as how is the mix of growth and profitability changing? And also, how you are suited to run in these conditions towards your ambition, better or worse. So whoever wants to go first.
I can go first. I'll take it in my context so that it's very, very relevant. We've been fortunate last year with the cost of capital being extremely, extremely low in the world to be able to raise a lot of capital, and we have deployed some of that in acquisitions. But I would say about 85% of the capital raised is still in the bank for us. So we have, technically, if we keep burning exactly the same amount of money that we burn today, we have about 4 to 5 years of capital left with us. So that's where we are at. We would also suggest companies to look at that irrespective of the funding environment that you have, because that's not a controllable variable in the business. And if you see, Ashish, in our entire conversations, we have spoke about run rate revenue. We have not spoken about valuations or any of that.
Right.
Because that's not something that you as a founder can control. You should take advantage of it, but not something that you should build your business around. So we've ensured that the business is built in a way that it's not dependent on capital to survive. It can reorient itself to ensure that the growth rates are readjusted to ensure with the capital that you have in your bank.
But just because we haven't spoken about valuation does not mean all of you are not getting great valuations. So you're doing the right things and that's leading to good valuations, right?
So it's a post facto, and we should consider it as a post facto. I mean, the revenue for P&L first. I mean, revenue first, P&L first, valuation next is the only suggestion that I would have to people who are building their businesses out. You would see the same companies valued differently in 2021 versus 2019 versus 2025. And it's going to keep happening. Build it for 20 years, you will see 4 cycles like this where you are peaking out on valuations, and take advantage of that. Don't build your business around it. That's the only suggestion.
That's a great suggestion. So, Vishal, let me come to you. It's raining? Is it difficult to raise capital? What are investors expecting, and how are you placed to deal with this?
No, first of all, I agree with Rahul what he said, and I think our job is first to run great businesses. Valuations will follow, and definitely, the capital markets have their cycles, right? Depending on growth, burst, everything. So right now, of course, the valuation, if the public markets are compressed, they will be compressed in the private markets. The private markets will follow the public markets. But having said that, F&B is a more traditional sector. If you look worldwide also, a Peloton or a Palantir would have fallen maybe, or Snap, or would have fallen maybe, 50, 60, 70%. Maybe even the best of the companies would have fallen, like Facebook and Netflix, maybe 30, 40%. But if you looked at it worldwide, McDonald's or Chipotle, they might have fallen maybe 15, 20%, not more than that, or even similar. And so there is definitely, but for startups, definitely there will be a valuation compression if someone is raising funds now. So instead of 6, 7, 8 times revenue, it will be more 4 to 6 times. But having said that, I think as long as the founders, we are creating great businesses, these are hugely, especially in F&B, if you've created a McDonald's or a Biryani By Kilo, these for the next 50 to 100 years, and the investors know it. They don't go out of fashion, of course, a big fan of high tech, but, they don't go out like a Motorola or a Nokia. So they stay for the next 50, 60, 100 years once created that scale, because the entry barriers on the scale for the businesses in F&B is very, very high. So having said that, I'm sure investors are also looking at long term, but surely in the short term, if a McDonald's or a Jubilant goes down 15, 20% or whatever, that there's going to be a valuation compression in the short run. But
what
not
does it mean for Biryani By Kilo? How are you positioned to deal with this rain?
So, no, we are well positioned. Of course, like everyone said here, we are prudent enough to know that we never run out of cash. Let's say if we really want, we can have an infinite runway if we stop or we reduce the growth quite a bit or reduce a few things, because at unit level we are profitable. It is only on the fixed side. So if we really want, and if we don't really look getting what we really want, it's not only the valuation, right quality of investor, which have the alignment of vision of creating a world-class F&B company, we can wait in philosophically speaking, infinitely. Right.
Gaurav, how are you placed in this?
Yeah, so I think one good part was that we were also not swayed by the extreme funding of last couple of years, and we were running business exactly the same way that we were running business in 17, 18 also. So that's one good part. At the same time, I think there's capital compression that is happening a lot more for kind of heavy loss-making companies, some of the companies that were that was the flavor of the season over the last couple of years, but companies that have that have a right balance of growth and profitability, I think there's a lot of dry powder sitting there, and honestly, it will have to flow somewhere. And given that there's so much focus on growth now from the investor side also, companies which are growing with profitability are not going to struggle. And in our case also, we'll wait and watch. It doesn't matter whether it is now, next year or so. So yeah.
Sneh, you're raring to go. Go ahead.
I think from a business side, we don't look at market situation. What we look at the consumer spending very closely, where the people are spending. Looking at past historical recession cycles that the world has gone through, at least products for kids have been the most successful, where at least in the western part of the world, it's known that parents won't buy their medicines, but will ensure that the kid gets what they want for Christmas. So looking at that, we are able to forecast with our channel partners on how the situation would be in the next 2-3 years. I think it's a golden era for companies like ourselves and all the ones in the panel here who have strong unit economics to focus on growth at this point of time, because a lot of noise has died down, which is good. And artificially grown companies have to take a long pitch stop, which is very good. So in a way, it's a golden opportunity for you to race forward with the right P&L and aim to be ahead of everyone globally.
Excellent. Mark my words, look out for these founders and these companies. They are here to stay. And again, thanks a lot, everyone, for sharing such wonderful insights. I can see all your cars finishing on top. All of you will be in the leader position in your respective races. All the best.
Thank you, Ashish.
Thank you,
Thank you.
Thank you, Ashish. Thank you, everyone.
Thank you so much, everyone, for such an intriguing discussion. I really like your point, Gaurav, what you said. Growth has to be right and not distorted. And I think the secret sauce is how to steer this obsession for growth towards profitability and yet being capital efficient. Thank you so much, everyone, for a wonderful discussion. May I request Ashish to please hand over the token of appreciation to all the panelists, and if you could also have a group photograph.
Mansi, meanwhile, I suddenly remembered about a conversation between an entrepreneur and an investor. The entrepreneur had submitted a business plan to the investor, and the investor asked, how much are the margins? Looking at the paper on which the business plan was printed, the entrepreneur said, oh, I think it's 2 inches on each side.
Oh, Madhuri, this was a good one. I really hope the entrepreneur was joking, else a poor investor.